All right there, partner. Welcome to Macroeconomics. We're going to talk about non-discretionary fiscal policy today, Mr. K. Hey, you think there, Andy? That was horrible. Oh well, I tried. All right, we're going to talk about non-discretionary fiscal policy. Mainly what we're going to talk about today is what the heck is non-discretionary fiscal policy? Well, non-discretionary fiscal policy is legislation usually made a long time ago. And we're going to talk about something that is counter-cyclical to the economy, right? It's counter-cyclical to what is happening in society, right? What we call automatic stabilizers. So before we said in discretionary fiscal policy, if we're in a recession, right, we want to increase government spending and we want to decrease taxes. Well, for example, our U.S. progressive income tax system does this automatically. When GDP is down, the tax burden on consumers is low, promoting consumption and increasing aggregate demand. Why is that? Well, because in a recession, people lose their jobs or they take a cut in pay. And the less money you make, the less you get taxed. The more money you make, the more you get taxed, et cetera, et cetera. Okay, so that's an automatic stabilizer. Same thing with unemployment benefits. As more people start losing their jobs, government spending starts to kick in, unemployment benefits goes up, it keeps people spending, it keeps consumers in stores, and keeping aggregate demand high. I'll let you pause that if you need to. Moving on. Taxes. All right, let's talk about taxes because taxes are not exactly what you think they are, right? One thing, taxes are mandatory. You have to pay them, right? You don't pay them, you go to jail. Or you have to pay a hefty fine and you have to pay interest on the tax that you didn't pay. If you're like, well, screw that, I don't care, I'm not paying it, IRS will come in and they will garnish your wages, which is a nice fancy way of saying they'll come in and tell your employer, hey, guess what? We're taking money from one of your employees because they never paid us. And that just looks bad, right? So pay your taxes. Most of you pay your taxes anyway when you go to a cashier or till or anywhere you go buy gas and stuff. You're paying it. You don't even know you're paying it, but you're paying it, right? Most people get mad at income tax, right? Because you look at all the money you made and all the hours you worked, and then you look at what the government takes, and you're just like, shit, man, come on. All right. But, hey, it is what it is. Why? Well, to finance government, right? And then to influence economic behavior. As we talked about before, taxes can influence and incentivize or disincentivize actions of people and businesses. 3 types of taxes. First type is progressive tax. Second type is a proportional tax, and the third type is a regressive tax, all right? So a progressive tax takes a larger percent from higher income groups and a lower percent from lower income groups. A flat tax takes the same percent of income, I'll repeat that, the same percent of income from all groups. And a regressive tax takes a larger percentage of income from low income groups, so it takes more from poor people. Now, when I talk to students, most people, when I say, I always ask the question, which one of these do we have in our society? Most people are like, oh, the progressive. We take money from rich people. I know we do that, right? Most people say, I wish we had a flat tax, which I always find that funny because most of my students are either young and don't have a lot of money, right? Or most people you come across really just don't have a lot of money. And really, if you don't have or make a lot of money, a flat tax really is not beneficial to you. A flat income tax is really not going to benefit you. It's probably going to hurt you. But if you don't care, you still believe in it, then that's fine. And then you have regressive taxes, which almost everybody's against, right? Most people say, oh, that's horrible. You take more from poor people? That sounds like something they do back in the Middle Ages, right? The kings and queens coming in and well, yeah. But to be honest with you, the most taxes you see, the one you think of most is your income tax, your progressive income tax. But the one you pay almost daily is a regressive tax, right? People are like, wait, we have regressive taxes? And like, we have all 3 of these, right? Income is taxed progressively. Medicare and Social Security is taxed proportionately. And regressive taxes are any kind of consumption tax, so sales tax, etc. Let's take a look at some examples. So pause the video. What I want you to do is explain what type of taxes are these. Are these progressive, proportional, or regressive? Think percent of income. Do not fall to the a lot of students always say, "Oh, hey, this is this," and they're completely wrong, right? And then we have an argument because they think I'm wrong, right? Hopefully I can prove it to you. So pause the video and name what type of tax these are. Okay, go. All right, and welcome back. Toll road tax. You probably said proportional, and you would be absolutely wrong. It is regressive. Wait, what? But it's $1. Everybody pays the dollar. How could that be regressive? It's a flat tax. No matter if you make $1 billion or you make $1, everybody pays the dollar. Yes, but you have to think percent of income. So if you make $1 a day, a $1 tax is 100% of your income. If you make $100 a day, it is 1% of your income. Ooh. And if you make $10, it's 10%. If you make $5, it's 20%. And notice as the less money you make, the more you pay of your income. It's a regressive tax. Ooh. You know, like, now you really hate tolls, don't you? State income tax, where richer citizens pay higher. And if you said progressive, you would be correct. 85-cent tax on cigarettes. Again, you probably said proportional, and you would be wrong. You didn't. I know you didn't, because you're smart. You figured it out now. I know you didn't say that. You said that is a regressive tax, because you're smart. And I would say, yes, you're right, because, and you would say, the 85 cents, even though it's 85 cents, if you made $1, it's 85% of your income, right? And as you make more money, right, $2 or $3 or $1 billion, right, it becomes a less and less percentage of your income. And I would say you're absolutely correct. Medicare tax of $1 of every dollar you earn, that is a flat tax. You earn $1, they take a penny. You don't earn $1, you don't pay a penny. That's flat. And a 5.6% Arizona sales tax. So 5.6 cents on every dollar you earn, that is a regressive tax. But if a rich person, right, if a person that makes $100 a day goes in and buys $1's worth, they're paying 5.6 cents. Yes. And if a person makes $1, they pay 5.6 cents. Yes. But the lower income person, that 5.6 cents is a higher percentage of their income than somebody who makes $100. Correct? It's the same as the toll. All right. We're going to stop it there. I'm going to put this into 2 parts so I don't inundate you with too much tax information. We'll be right back.